All right, everybody, I'm gonna go ahead and read the disclaimer. We are not financial advisors, and this is in no way financial or trading advice. We are simply sharing options trading strategies that we use and have been successful with in the stock market. This presentation is for educational purposes only. There are significant financial risks involved with trading, and we are not responsible for your losses in the market should you decide to utilize the information and/or strategies discussed within this presentation. And by choosing to proceed, you are acknowledging your understanding of this disclaimer. Can we get a 5 in the chat if everybody understands this? All right, you can go ahead, Ray.
All right. So, like that. All right. So, process for plays. All right. So, this to me is the way you should be going through it, or something similar to this. It should be like a step-by-step process. All right. So, step one, identify your plays by scanning for setups that you like, or by manually going through a list of stocks you have. So, me personally, I scan through a list of stocks I have. I know some people go through them manually. Like Kay, she goes through everything manually. She wants to see her whole list, all right, and then pick the best of the best from there. So if you do it that way, then continue to do it that way. But you need to, one, identify your plays, right? So you need to scan or come up with a process for how you scan. You need to actually figure out what criteria it is that you like to look for plays. If you're strat based, then you would just look for, inside candles, bullish two downs, bearish two ups, outside candles, things of that nature. All right. As far as like whenever you scan for plays. And step two, mark your entries and your price targets. This is key because going into step three, but you need to know where you would enter it and what you're actually targeting. You can't just say, oh, I'm gonna play this the next day. I just get in whenever market opens. You need to actually know your entry point. All right. Know your price targets if you have more than one. All right. I always have more than one price target just in case it continues. I can be like, all right, this is where it could go next. And I'll know what my risk reward is going to be based off of that. All right. So make sure you mark your entries, set your alerts. Kay has been on me about setting alerts. I've been setting alerts. All right. So always set your alerts, even on price targets, set your alerts just in case you look away and it gets away because maybe your alert only works for the initial time it triggers. Set alerts on your price targets as well, just in case you're doing some multitasking and the stock just start moving crazy and all of a sudden hit your price target. So you will know to either get out or reassess if you're going to continue to hold. All right. Step three, research your option contracts and pick the best one with the best risk reward. You need to be analyzing your option contracts. Whenever we get to the end, I'll go over like an example of like how to do this and stuff like that. All right. For specifically Thinkorswim, but use option profit calculator. But you need to even know what you're gonna get out of that trade, because what you may be getting out of that trade might not even be worth even participating in that trade. And the key of marking your entries and your price targets, so you can even look up, all right, if I enter here, this is what the price of the contract will be here. This will be the price of the contract whenever it hits my price target, my first price target, my second price target. All right. So knowing just what you would gain from the trade, sometimes that can alone can keep you in the trade a little bit longer to potentially hold through those slight corrective activities before price continues upwards. All right. So, like for instance, if I gave an example, the Oxy play that I put in there, the Oxy Lotto play, I knew if we hit 6160 the next day on Friday, that would be 1,000% play. I marked that out. How did I do that? Because I knew one, where I got in at, and I knew the price target, as well as, just ATR of how Oxy can move if it really goes crazy. All right. These are all the things that you need to be doing and you need to be writing down. For the simple fact of step four, rinse and repeat until you have 3 to 5 setups. If you have more than 3 to 5, then you need to go through the reasons for the plays and pick the plays with the most reward along with confluence. So what do I mean by that? One, if it hits your price targets, what will you gain? What percentage return? Is it 30%, 40%, 100%, 200%? All right. The next thing, how many indicators, if you use indicators, what type of setups do you have? Do you have your MACD crossover? Do you have your TTM squeeze potentially fire? Do you have TTM squeezes on multiple time frames? Maybe if you've even used MACD, maybe you got MACD crossovers on multiple time frames. All right. Let me see what else. Catalyst, news catalyst for Oxy. All right, we had the ban on Russian oil. All right, is there a price target upgrade? All those things you would write down. So one, you can even know what all that's going on with that play. And again, this will help you shorten that list that you will have. Because if you're looking, if you got 6 or 7, right, and only 3 to 4 of them have all the things you like to look for, along with news catalysts, price target upgrades, then maybe you just stick to that 3 to 4. It's going to make numbering down your list easy. But if you just look at the chart and you don't do the research on the option contract, if you don't look at what else is going on with the stock, you're not going to know why to even shorten the list or what to even go with. All right. These are the things that you need to be doing, because you don't need to have a super long list going into a trading day, because when the market opens, things are going to start going off. Your emotions going to go everywhere. You're going to feel antsy a lot of times. So you're not even going to know what to go with. All right. So you need to be sound, because sometimes you get those fake breakouts and the things of that nature, to where you might hop into something just because it initially looked good. But the things that you actually researched and paid attention to and knew the setups for, they actually might not have went off initially, but towards the further in the day, they actually start popping off. Some plays are just late bloomers. They don't go until 2 to 3 hours in the day. All right. So after that, the mentality. All right. So the mentality, rule number 1, stick to your list. Stick to your list. Forget everybody else's list. Forget everybody else in the chat list. Stick to your list. All right. Your list. Stick to it. Whatever you say you're going to look at that day, stick to that. I don't know how many times this happened to me where I moved one play out the way for something else that was actually on my list and put something that wasn't on my list. And then the one that was on my list it sneak off on me. And then the one that I swapped it out for don't do nothing. I'm sure we all can attest to those times where we moved something off our screen and it snuck off on us. Stick to your list. All right. If you have put the time and effort into creating a checklist for your list, knowing what you like to look for, and constantly always getting those same plays that you like to look for, and you've seen that your strategy works out for you, stick to your list. Stick to what works for you. All right, because you know what type of trader you are. You know what you looked at. You know how much time you spent going through, whatever it is that you like to look for in a stock. All right, stick to your list. That's the number 1 mentality you should have. You should be selfish and just stick to your list, your good. All right. 2, know why you are entering the play. And you should know why if you have a process like the one above, the process for the plays. If you don't know why, you will exit a play too soon or not enter it at all. All right. You won't. A lot of times, the reason why people are exiting their play too soon is because they don't even know what the reward would be if they actually held to their price target. And I'm not saying hold something that's clearly reversing, like it went up and it's clearly done retraced the whole range. I'm not saying stay in that. All right. I'm talking about on those little pullbacks where you're up like 60, 70, 80, 100%, especially if you're at 100%, you should just take your initial investment and let a runner run. It could just be one contract. But if you don't know what the reward is, you're not even going to know to stick in a play. What happens is a lot of people know what the reward is because they go back and they look at that contract that they had and they be like, dang, if I would have held, that would have been an extra dollar. If you know what the contract would be by going back and look at it, if you go back and look at it later in the day because price kept going in your favor and you're like, dang, I would have had this. You should know that beforehand. You should know what, again, your reward will be if it hits all your price targets, or if it even moves its average true range or a little bit more than its average true range. All right. A key to that is look at the average true range, right? See what the stock moves on average. Then on days, go back and look at the chart and see the days where it's moved above that ATR and say, oh, we have a great day. Well, then this is the potential that it could be. Because along the lines of the great days on the stock, you'll be able to see like a trend with that. So like I knew Oxy had the potential of getting to like 61 something. I didn't know it would go all the way to 62. I was like, oh, we could probably hit 61. All right, 61. I think I had 61.60 for 1,000%, but it got all the way up to $62 Friday. So like when you know a stock and you've traded a few times, but you also go back and say, all right, when we move more than ATR, this is typically what it likes to move. You can adjust and say, all right, this is the range and this is what I would be at my price target. But what if we do more than normal? This is what my reward would be. All right. Then 3, snipe your list. The reason list is small and concise is so you can be a sniper and execute your plays. All right. The reason you won't is if you get distracted by other plays that aren't your own, which goes back to what Kay said. In other words, stick to your list. But the reason why, again, the list is small is because if you have 10 things, right? And when you go into a trading day, you know what it's like when 10 things go off all at the same time? You don't know which one to get in. So you probably get in all of them. The reason why that's not necessarily good is because now you spread your money thin across 10 different plays or across 7 different plays. Whereas if you just concentrated your money into 2 to 3 plays, if 2 of them you lose on and you say your stop loss is 20% and one of them you get 100% on or 80% on or 50% on, whatever, you can counteract those 2 losses, right? But when you're in 10 different plays and you lose on 7 of them and you win on 3 of them, that's not a good risk to reward. And now again, your money is diverted all over the place. Now you can't add to your winner if you wanted to add to your winner. If you're good at averaging up on pullbacks, whenever you get the reversal back into your direction, sometimes that's like where I like to average up at. You won't even be able to because you'll be out of money. All right. So 4, wake up before the market. All right. At least 30 to 40 minutes before market. See if there's any news or catalyst that is coming out about your stock on that list. That way you could be prepared. Like for Walmart, it was one of the days that Walmart was talking about. I think that was Thursday. They said that they were gonna pay their drivers more. That's a potential catalyst and things of that nature. Um, and that actually, I think, led to Walmart actually running some more. So like you would want to know those things before the market. That way you can say, all right, I got this list of 3 to 5. Well, let me actually now put them in order from what I like the most to what I like the least, which was, I think, yeah, that was Thursday. Why I went so heavy on Walmart. And that's why I was like done, I think 30 minutes into the market because I already knew beforehand, all right, Walmart got a catalyst. It's at least going to pump probably the first 15, 30 minutes. I can be done. Let me just roll the dice with that, take a calculated risk. And then it paid off. All right. So that comes from knowing what's going on, pre-market things of that nature. If you're playing something like Oxy, maybe you look at US oil futures. That way you can see what's going on with that because that US oil futures being up could be making oil gap up. All right. So that's something you want to pay attention to. Or if you got something in SPY, pay attention to like the ES futures, see where that's at. Actually look at the chart. Don't look and see if we're up 10 points or 100 points or whatever, whether we're red or green. Actually look at the chart. All right. Now, to sum it up, the mentality that you want to have and the approach that you want to have is that of a sniper slash assassin. You stalk your prey. All right. You know everything going on with your target, which is the stock, right? Your target. From news to how the chart looks to what the best opportunity would be to execute the mission, i.e., the best contract, so you can really snipe slash assassinize, whatever you want to call it, your target, which is that stock. That should be the mentality. Snipers, they're only looking at a couple of things, or whenever they're on a mission, they probably looking at one target, but they know everything about the best time of day, their schedule, their routine, and then they got a time picked out of, all right, this is where I'm gonna execute. All right. Same thing you need to do whenever you're approaching. You need to know, all right, this is my entries, these are my targets, this is my contract. All right, you know your contract beforehand. This is my contract. This is how much I would be rewarded if it pans out the way I'm theorizing that it will pan out. As well as here's the news. This is the last week's worth of news. Because sometimes there might be like a delayed reaction. Like Oxy had so many upgrades throughout the week, but it didn't really pop until like Thursday, Friday, which was because of Russian oil ban. But they had already given it price target upgrades earlier in the week before that. All right. So you want to know those things as well as what's going on again with the chart, with whatever indicators that you like to look at, write all of that down so you don't forget. I know I be forgetting a lot of stuff, and that's why now I write all of that down because I don't want to forget and exit the play because I forgot that, oh, well, if it does this, this will happen, or this has yet to fire, or something's going on the daily, or something going on the weekly, or some news. Like, for instance, Oxy, there was a lot of call sweeps on the 75 call for May 20th. All right. So I'm looking at all those things. Now, an example of all this is that I didn't mark out would be like SLB. All right, because that's the honorable mention. So I'm gonna clear all of this out. So whenever I'm going through the chart, right, first thing is to acquire my entries, right? So for the week, the entry is um mark the high and low of the candle, right? So then I'll mark, all right, entry calls week, change it to a dotted, I don't know what this would be, like a slash, whatever. It's not a straight line, it's some slashes in there, whatever you call it. All right, dashes. All right, entry puts week. All right, then I go to the daily chart. What we got? All right, Friday's high is the high of the week. So now I just mark the low because now I got an earlier entry for puts. All right, so entry puts daily. Boom. Next thing I do, I go down to the 4 hours. So I mark the high and low of the week candle, the high and low of the day, but the high of Friday is the high of the week. So I don't have to mark that for a daily entry. Go down to the 4 hour and see, oh, there's a 4 hour entry for puts, right? So there's only one entry for calls. You trigger the 4 hour, the day, the week, all whenever you cross, if SLB crosses above 42.72. All right, entry puts 4 hour. And now I'm going to show you the reason behind this once I mark the price targets. All right. So now I mark the high of the weeks that haven't been taken out to the right. All right. So I mark those highs. So then I have PT, which means price target. Oops. PT1 calls week. That way I know these are price targets that I found on the weekly time frame. And I say PT2. All right. Then I go PT3. And if I go up in time frame, like I go look at the month, I'm gonna go look at that month, quarter, and all that stuff here in a second. Then I would change that if any of these are a price target on a higher time frame or something like that. So we don't really have a price target on the daily. We got one right here, but it's so close to that one, I'm not gonna mark it. But then we do have a PT1 for calls on daily right there. So boom. Oops, I thought I changed it. All right, there we go. So PT1 calls daily. And then I'll leave it like that. And then on the week, I just changed that to the month just to double check, see if I marked any price targets on the month. All right, so PT3 calls week. This would be a 3-2 month if we break above it. So 3-2M, that's how I call it instead of writing out month. Yeah, this is Thinkorswim TD Ameritrade, TD Ameritrade Thinkorswim application. All right, so 3-2 month, because this candle right here is a 3. My 3 candles are blue. My yellow candles are inside candles because I wanted to get rid of the numbers because I don't need the numbers. I just rather just color coordinate what the candle would be if it's a 1 and what it would be a 3. So change 1s to yellow, 3s to blue. All right. So that's the month, and I'm pretty sure also would be a quarter entry as well. So on that same 3-2 month, that also gives us a 2-2 quarter. I could add that if I want to, but I'm not going to add that right now. And then right here, I'm going to mark this PT1 on the quarter. PT1 calls quarter because this is the quarterly time frame. And I know if you're day trading and stuff like that, you might be like, oh, well, there's no need to go out that far. Sometimes it is good to know because if the price really starts moving in your favor, what might have happened is they might have crossed something on the month and quarter or something like that. And now when you're letting your runner run, it really ends up running. That's why I'd be like, go ahead and look out further. That way you can go like, oh, I'm gonna grab a week out, I'm gonna grab 2 weeks out. Because what you might be getting is a great entry on a reversal of a trend or reversal back into a trend. And now you could be getting in at a great entry. And if you just day traded, you might have left a great entry for a further out contract that leads to 1,000, 2,000%. Um, and that's why you got to go through here and look at what the risk reward would be. All right. So now look at the quarter. All right, boom. I got my quarterly price target. I already know for the year we're directional. Did a 212, which actually this PT1 on the quarter is actually PT1 for calls on the year. So now I changed that to a year. And that's why I mark it out the way I do, because I want to know what time frame it is. Because the higher the time frame, when you start hitting these price targets, price may pull back. All right. So a lot of times you might trigger or hit a price target, and then it pulls back based off of how high that time frame is, because that might have been all they wanted to do on the year or whatnot, or so far up until this point. And then there's a pullback period, and then eventually they go back and retest it. All right. So that's how I look at SLB. Now, to truly see what's the difference between the 4-hour entry and the daily week entry. So I'm gonna have to do it for puts because calls is just one, right? And I didn't really mark out the puts, but I'll do like PT1 for puts on the daily, which should be that. Let me actually double check, make sure that isn't a weekly price target. So zoom in. Nope, it's not. So we do PT1 puts. Daily, market red. All right, so I'm gonna show you 4-hour entry, put the daily entry, and then a week entry. Go in the analyze tab. What I'm gonna do, if you're making different entries for every single time frame, how do you know which time frame to enter on? I'm not entering on all those. So basically what's going on is I'm gonna enter on the 4-hour entry. That's the earlier entry. And again, I'm about to show you why this is important. I'm entering on the 4-hour entry. The daily entry and the weekly entry is just so I know when those time frames are directional. Because if I'm already in here, if we go directional on the day, all right, now we're in force. We're two down on the day. That further helps me see that we're leading in my favor. We're basically helping my theory, confirming my theory, basically. All right. And then when we get directional on the week, that's an even higher time frame. It's not confusing because I'm just entering on the 4-hour. All right. So I'm going to enter here. I'm not going to wait all the way to here. And again, when you go into the risk profile calculator, right, this is going to show that. So if I go to April 14th and my entry is 42.30, a lot of times whenever I make the watch list and chill, I'm just going to give you 42, right? But I also could go 41 because 41.11, that's the entry for puts on the daily. 41 put would be in the money literally 12 cents after it breaks the daily entry. All right. Or I potentially could go 40. So I'm gonna load 40, analyze by single, and I'm also gonna load 41. All right. Analyze by single. All right. Now, what I'm gonna do is I'm gonna unclick the 41 first, all right, because I'm gonna analyze the 40. And I gotta find those 3 price slices. I don't know where I put them at. All right, here they go. And basically what I'm gonna do is I'm gonna line up the 4-hour entry, the daily entry, and the weekly entry. So 42.30 is the 4-hour entry. So 42.30. So I'm gonna get as close as I can to it. Sometimes it's hard to get it like right on the needle. So 40, hold on, what's that? 42.30. All right, I'm tripping. 42.30. All right, 42.31 is good enough. Then entry for puts on the daily is 41.11. 41.11. And then entry for puts on the week is like 39 something, I think. 39.74. 39. All right, that's good enough. So now let me actually change this back to tomorrow's date for April 11th. Yep. April 11th. That's how you control it. So basically at the bottom is the price of the stock. Over here is the price of the contract. The purple line is the date that you set down here. The blue line is the price at expiration, which is going to usually be the next day. It's going to say that. So if your contract expires on the 14th, it's going to say the 15th. If it expires, let's say you load up next week's contract, the 22nd, it's going to say the 23rd. All right. It's always going to be that next day. So it's basically just saying market close. All right. So how you figure out what you pay for your contract if it's puts, because for the calls, it's going to go the other way. All right. So for puts, it's going to be directed backwards. So the red line on your right is what you need to move whenever you're adjusting a price. That's what you need to move to your price slice because the orange lines are price slices. All right. Um, the red line to the left is going to be break even. So left, right is the price of the contract. That's where you need to move the line to whenever you're adjusting the price down here. All right. The line to the left is what your break even is. And how you calculate break even for puts is you would take what you pay for the contract and you minus it from the strike. So in this case, the strike is 40. You're paying 24 cents for it. It'll be 40 minus 24 cents. Your break even would be 39.76. All right. The same thing for the other one. And then for calls, you would add it. So let's say your strike was 40 and you paid 24 on the call side. You would add that 24 cent. All right. And then your break even would be 40.24. That's how you figure out break even. That's what that second red line is giving you, the break even price. All right. So if we enter on the 4-hour entry, that 40 put would cost 24 cents. All right. If we enter on the daily entry, if I keep moving the line over, all right, this is the daily entry right here, 41.11. We would pay 53 cents. That's already 100%. From the 4-hour entry to the daily entry, that's already 100%. All right. So again, this is why um the entries matter. That's why I'm giving you a 4-hour entry. The daily entry is just so when you know it gets directional. All right. So if you're in on the 4-hour entry, once it crosses the daily entry, that means we're 2 up on the day. All right. Whenever we get to the week entry, the same 40 put, when we get to the week entry for 39.72, all right, that's going to be $1.11, which is 111 divided by 24 is that's already a 400% play from the 4-hour entry to the week entry. All right. So hopefully that's explains all the different entries of you knowing, all right, we're going to enter on the 4-hour if there's a 4-hour entry. By the time it gets to the daily entry, all right, now we're directional on the day. You know the strat, we're directional on the day. All right. When we get to the week entry, we're directional on the week. We're 2 down or 2 up or whatever on the week. But that 4-hour entry, you're going to pay less for that contract there than you're going to pay at the daily entry, than you pay at the weekly entry. All right. Does everybody understand that? Put a 3 in the chat. So that's why I have those different entries. Instead of just marking all those different price targets, you still need to keep track of, are we directional on the day? Are we directional on the week? That's how I do that. Can you show an example of option profit? I don't use option profit calculator personally. I never liked it. I just like Thinkorswim with it. Hopefully there's some other better ones out there that somebody uses, but I don't personally use option profit calculator. I don't even know how to use it. K might, but I don't. Um, so basically that's the example of that. Now for the call side, right? All right, so entry for calls on the week, that's basically all the entries, right? 42.72. Let me go ahead and move that there. 42.72. Show the call side. So that was just an example of all the different entries. Because this is oil, so let me do 42.73. Then what's the next two price targets? 43.45 and then 43.72. 43. Yep. All right, that's good enough. 43 and then like 43.72. which these are all close. Also, you also want to like go to the next day, because obviously on that week entry, I would doubt that, I mean, it's not impossible that we fall from here all the way to there in one day. But you got the example of it basically would be different prices. All right. Now, 43.72. All right. Yeah. So if we got let's see, the entry is 42.72. So right here, we could either go 43 or 44. Now let's take into account ATR, right? So the ATR, the average that SLB moves is $1.76. That's not saying in one direction. That's saying the range of the candle. Like this 3 right here, it basically didn't move too much more than the previous day, but it still had a range of $1.98. All right. So I would put in a calculator. I would be like, all right, the entry is 42.72. I mean, the price is at 42.55 right now. If it moved straight up the whole range from 42.55, right? If it moves straight up and moved that range, that'd be plus $1.76, right? Which would be 44.31 tomorrow, potentially, right? If it just went open, boom, straight up, took straight off. All right. I'd be like, let me load in the 43, right? Because that's the closest one. Load the 43 in there. Make sure those are on. And then load the 44. And I'm also going to load the 45. I'm going to show you why. All right. So analyze, boom, by single. Then the 45. Analyze by single, right? So we got the 43. And I didn't even go over that other contract, but this time I'm gonna go over all three. We got the 43, 44, 45. Now, what I'm gonna do is I'm gonna set all of them up to have the entry, like what it would be at 42.73. So for the 43, all right, 0.79, I'll unclick it, click the next one, 44. All right, that's what it costs at that entry. And then unclick that, click the 45. All right, boom. So those are the cost basis, right? Now, what we're gonna do is go over the risk, right? The risk, we're risking 20%. All right. So what's 20% of $79? Because we know we would pay 100 times 0.79, so $79, right? 79 times 0.20 is 15.8. So that would be a loss of $15.08 on that play, right? $15.08 for the 43C. All right. Next, $46. 46 times 0.20. 20% of that, risking $9 on that contract. $9 and basically like 20 cents, right? First one, $15 and like 80 cents. Second one, $9.20. All right. Now, for the 45 call, 27 cents times, $27 times 20, $5. All right. So 44 would be $9.20. 45 call would be $5.40. Now you lost again. You might have to just rewatch it. What I'm doing is basically I'm going through the contract, right? From on entry, we would pay for the 43.79, aka $79, right? For the 44, 46 cents, aka $46. The 45 call, 27 cents, basically $27. What I'm doing is calculating my risk. I risk 20% going into a trade, 15 or 20%. For this example, showing 20%. So we risk 20% of $79. That's going to be $15.80. We risk 20% of $46. That's $9.20. We risk 20% of $27. That's $5.40. That's basically let me know what my risk is as far as what I would lose if this contract, when I enter it, if it pulled back 20%, this is the dollar amount that I would lose. Obviously, if you buy a bunch of contracts, then you would times the amount of contracts that you have. All right. Now, for the first one, we need to figure out what we would gain at PT1, PT2, which are those two that's marked right now. And then I'm gonna move this one to the ATR range of what it would move. I'm gonna calculate that again. So PT1, PT2, and then if it moved like the full ATR to the upside. All right. So for the 45 call, 43 call, if I just click on the price slices, PT1 is 43. Let me zoom this out. So it's 43.46, 43.72. So if I look at that 43.46 on this first contract, 43, if we hit PT1 of 43.46, that'd be $37 profit because it's not going to give you percentage whenever you do this. It's just going to give you dollar amount. So $37.64. Then we just have to calculate what percentage that would be. So 37.64, 37.64, PT2, 53.50. All right, so now just go to the next contract. Then pay 79 for it. Next contract, the 44 at these two price targets, 43.46 and 43.72. Yeah, it would be basically what you get paid per contract, right? And I only got one selected. So PT1 for the 44 call would be 25.41. And then PT2 would be 36.92. And then the second price, the second contract, I meant the last contract basically. So let me see, 46. Let me see. All right. In the last contract, if I show the price slices for the 43.46 again right here, profit loss would be basically the profit on it would be 16.75, and then 24 on price target 2. All right, 24.61. Now, let me figure out what that was again. 42.55 as far as the ATR moves straight up. So I'm gonna add it to where the price closed at. So 42.55 plus $1.76, which is the ATR, because the DTR just means what it moved that day. So SLB moved Friday $1.61. So if I do where price closed at, because I'm not going to do it from where I enter, I'm going to do it from where it closed at to where it closed at plus the ATR. If it went straight up, what it would be. And that would be 44.31. And then if I go to the price slice, move this to 44.31. And this would be like, if SLB just really shot out of a cannon Friday, all right? The price slice for the first contract at that 44.31 would be 93. So for the ATR move, the whole ATR move to the upside, 93.48. And then for the second contract, all right, it would be 67.18. And then for the last contract, the 45, all right, that would be 46.04. All right, so let me rewrite this out. So 43C, pay 79, first price target is 37.64, 3.50, 93.48. Second one, 44C, 0.46, 20.41, 36.92, 67.18, and 45C, 127, 16.75, 20.61, and then. All right, so if we don't use Thinkorswim and we use TradingView, how could we go about setting up you have to use like an option profit calculator or something like that. All right, so as far as what we would pay for the 43 call, we would pay 79 cents. If we hit price target 1, our cost would be, our profit would be $37.64. If we hit price target 2, our cost would be, our price profit would be 53.50. And then if we hit ATR move, it'd be 93.48. For the 44 call, we would pay 46 cents. At PT1, the value on that contract would be 25.41. So that's the profit. And then the profit on PT2 is 36.92. And then whenever we hit, if we do the full ATR move, that's 62.18. Then for the 45 call, if we our payment would be 27, right? First price target, our profit would be 16.75. If we hit PT2, our profit would be 24.61. And then if we move the full ATR, that's 46.04. Now, all you would do from there is like, all right, which one has the most risk reward? To me, the one that has the most risk reward so far, if I had to do the math, I would say probably that 45 call, just off of cost basis, what I'm risking, the profit loss, as far as like the profit as we keep going. And then if we continue the next day, I know it's going to be even more. So as far as percentages wise, 45 is going to give you the most percentage wise. 43 is probably going to give you the less percentage wise, but the 44 is like right in the middle. All right. Does everybody understand that? Put like a 3 in the chat. Did you set up a stop loss? And this is the risk. The stop loss is what I already know I'm going to risk going into the trade. So I know I only risk 20% going into a trade. And as far as like the losses on those, again, for the 43 contract, it would be risking 15.80. For the 44 contract, the risk as far as dollar amount would be 9.20, so $9.20. And for the 45 call, the risk would be $5.40. So to me, again, the one in the middle is the safer bet is 44C. The one with the most reward is going to be the 45C. All right. So ultimately, that's how you would do it as far as like going about seeing what your risk reward is. You're right. All right. If it hits my stop loss, if my stop loss is 20%, boom, this is that price. This is how much I would lose, dollar amount. So because we know the percentage, we need to know the dollar amount. How do you calculate break even? If it's calls, the way you would calculate your break even is by adding what you pay plus the strike price. So if I had to show an example off right now, let's say the 45 call, the break even would be 45.27. All right. So it's 45, the strike price, plus the premium price, AKA what you pay. All right. That would be 45.27. Using TOS and doing this charting, are you actually setting the contract up to buy? No, I'm talking about the alert to like notify me that we crossed the entry. I don't do automatic orders. I do everything manual. But yeah, that's how you would calculate break even. All right. And then the other part of this, what you would do is if you're planning on holding, then you would just be like, all right, what would it be if it moved, the next day in my favor? So then you would just go up an expiration date and be like, all right, if we move this tomorrow, then you start looking at your higher price targets. All right. And a lot of times that's better. It's good to like have a rough estimate before you go into the day, but then after the day, you can actually come back and recalculate what it is that it actually would be based off of where price actually closes. All right. So ultimately, that concludes my TED talk. All right. Hopefully, this was very informative for people to see how you calculate things, your risk management, how you can see what your reward is, how to actually think, the mentality to have. We should be assassins, killers, all that stuff. All right. Not literally, not literally, figuratively. All right. Never know. All right. Oh, so now we can get to the questions. Like we got like 10 minutes left for questions. Bare necessity. Is that how you say that?
The Jungle Book. You never seen the Jungle Book?
I don't remember that.
Okay.
I think this is recording. Yeah, I didn't forget. All right.
That's good, everybody.
Bear. My God, you off mute. They off mute. Hootie ho.
Can you hear me?
Yep.
Yep, we can hear you now.
A quick question. All right. So, how are you determining where to enter your bids at?
By the price that I would enter at. So that's why I got these entry for calls on the week, entry for puts, the entries, the multiple entries I have. That's how I figure out what I would pay at that price.
Yeah,
Uh,
$1.
I got it. Thanks.
No problem.
Yep. Y'all, we have 10 minutes, so
Jay,
Oh, bet. My question was like kind of similar to his a little bit. Asked in the chat earlier. You said you enter on the 4 hour.
I'm using a 4-hour entry, not necessarily the time frame.
Oh, wait, yeah, okay. That was my question. Like what, like during the day, like when you're watching it, do you usually enter on a different time frame or?
I mean, price is going to be the same across multiple time frames. I mean, it's the same price everywhere, right? But intraday, generally speaking, I'm watching the 5, 15, 30 hour all at the same time.
Oh, okay. All right, that clears it up. Thanks.
No problem. You're welcome.
Ruby.
mm,
All right. So yes, whenever we're intraday, I'm generally speaking watching the 5, 15, 30-minute hour all at the same time. And then if there's certain reversals or things setting up, I may look at, other time frames because I like to mix and match. So a lot of times I also like to use like the 2 hour. So for example, like Oxy, um, that day I fell asleep, was like Thursday. It had a hammer on the 2 hour, ended up doing like a 2-2 reversal on the 2 hour. All right, which if I mark the entry level for that, right, 56.23. Then eventually on the 4 hour, it actually ends up going 3-2 reversal on the 4 hour. So if I mark that level right there, it's going to be one of those 2 hour price targets, right? Which actually is the highest part. So this 2-2 reversal, once we hit the top of this bearish 2 up, once it hit that, it triggered the 3-2 reversal to the upside, and then Oxy continued to run that next day. All right. So I'm always looking at multiple time frames. I use multi-time frame analysis because sometimes the 2 hour, even though the hour might say you're directional, on the 2 hour chart, it might still be an inside candle. So that's why a lot of times traders will say, oh, the best time frames to trade is the first 2 hours of the day and the last 2 hours of the day, right? Because around that, what's it for me? Around that 11:30, 11:45 Eastern time, 10:30, 10:45 Central time, 9:30, 9:45 Mountain time, 8:30, 8:45 Pacific time. That's when things start to consolidate after that initial push, those first 2 hours. What do you use to find stocks to create your watch list each day? Strat setups.
yeah. What do we use to create to find stocks to create our watch list? So I mean, you can create a list of stocks that you are familiar with, you know what I mean, that are pretty well known. You can actually go look through certain sectors like the ETFs and see which ones have a higher weighting within those sectors. You can use FinViz. You can also use a scanner. There's a website called usethinkscript.com, and you can utilize that to find different types of scripts for TOS. Like there's a bunch of different things that you can do. You can use runstrat.com. Ray, what was the one Ray uses? Transpider. You can use Transpider.
And Derek, resources on TOS scripts are in the market facts and resources under strat resources.
Yeah.
All right, and tutorials. B Hope, what's your question?
Yeah, thanks for that. Can you hear me?
Yes.
All right. Well, my question was that, like, so I'll set my entry points for calls or puts, but I have an issue with jumping in once it hits it. So my question was, do you wait until it opens above that price point to enter? And then even then, what timeframes are you looking at?
So you can actually wait, like when we enter into our trades, we have our entries mapped out, right? So you want to see when the candle actually breaks above that particular line, that would be your entry, but you want to make sure that the volume is consistent. You don't want to get into it when it's like, for example, you're going to have like the red and green ticks. Well, if you're getting into calls, you want it to be more consistent, buyers stepping in, and you also want a consistency in relation to the average volume. You don't want it to be, you don't want it to have volume but be very low volume. You want the consistency in the volume as well as the buyer stepping in if you're getting into calls, or the seller stepping in if you're getting into puts. I think they muted again. And the timeframes that we look at, we have a timeframes outline in Market Facts and Resources. Is basically going to outline however you plan to trade. So if you're going to be swing trading, it outlines the timeframes to look at to swing trade. It also outlines your entries. If you're going to be day trading, it outlines the timeframes to look at as well as your entries. The same thing for long-term investing. So go to timeframes to look at when trading inside of the Market Facts and Resources channel. And for everybody that's asking, this class will get posted in Wealth Squad University in within like a day or two.
Thank you. I really appreciate that.
No problem.
If you're trying to figure out how to do a stop loss, you need to use YouTube and see which brokerage, like YouTube your brokerage, because it's going to be different brokerage to brokerage. So we don't know what brokerage you have. So the best way to do that is figure out how to do it on YouTube. We tell you how to do stop losses as far as, you know, good percentages to potentially have a stop loss at. And then the last question is, just do, how you say it?
Hi, can you hear me?
Yes, ma'am.
So in the last question response, you guys had mentioned being able to visibly see buyers or sellers stepping up. I just want to know a few of the indicators that, you know, well, the prime indicators that both of you guys use for that. And if you're looking at level 2 also.
Yeah, we're definitely looking at level 2 or higher. And then Ray, do you have your trading view up? I mean, you can show the volume ticks on Thinkorswim, but like, for example, I'm going to see if Ray can put like, okay, so you see how the volume and Ray, are you using RVol? No, you're using Ultimate Volume. Okay, so this is a little bit different, but this is a script for TOS. It's pretty dope, but same difference, even if you were in Trading View. Okay, I think he's getting ready to pull it up. Hold on 1 second, you guys.
No, I'm about to share this script before people start asking me for
Okay,
it.
cool. So if you, once he moves this out of the way, all right. So as you see, there's a moving average turned on his volume bars. You see that line that's kind of going horizontally across those volume bars. So that's a moving average, right? So he has that turned on. That lets you know if it's trading below its normal amount of volume, if it's right at its average volume, or where you see closer towards the end, like those last, 4 ticks, especially that fourth one. That fourth to last one, you see that it traded well above the average. And if you take your eyes straight up and look at that candle that's on that chart, it reflects the buyer stepping in. So what you want to make sure is that not only is obviously the color represents who's in, the buyers or the sellers, you want to make sure that it's more in favor in the direction of whatever you're getting ready to get into. So if you're getting ready to get into calls, you want to make sure that it's more buyers stepping in favor of calls, but you also want it to be a consistency in where it's trading at on average. You don't want it to be very, very far below average, and then you get one little spike and then it's far below average again. That if you look kind of in the middle almost to where the chart where you see the on Wednesday, if you look right above the where it says Wednesday, right? And you look at those volume bars, look at all of those candles around it, those ticks around it on the volume, right? Go a little bit lower, Ray.
Hmm?
Go low. So pan over Wednesday, go down and pan over Wednesday. Go down,
This is
go down.
Wednesday.
No, go down to the volume, my friend. Yes. Now go over on Wednesday on the volume. Go to Wednesday.
This is Wednesday.
No. I want you to go exactly where it says Wednesday. I'm trying to
Oh.
show them. Yeah. Okay. So you see how you have that tick right there, and then the 3 to the left is kind of like very low, and then the 3 to the right is low. And then if you actually look at the candlesticks on the chart, it looks like a chop shop. It looks like up, down, up, down, up, down. It looks like a chop shop. You don't want that. You want consistency in the volume ticks. You also want the right participation group to be in as well. Does that make sense?
Yes, thank you so much.
No problem. No problem. I think you said